Warren Buffett, the Oracle of Omaha, is one of the most successful investors of all time. He's known for his simple yet powerful investment strategies. Buffett's wisdom has guided generations of investors. But when it comes to real estate, he holds a surprisingly contrarian view. Despite its popularity, Buffett doesn't consider real estate an ideal investment. Buffett's skepticism stems from a deep understanding of investment fundamentals. He prioritizes assets that are easy to buy and sell, generate consistent income, and have the potential for significant growth. Real estate, in his view, often falls short in these areas. One of Buffett's primary concerns with real estate is its lack of liquidity. This is a significant issue that many investors overlook when they are drawn to the tangible nature of property investments. Liquidity refers to how easily an asset can be converted into cash. Stocks are highly liquid, meaning they can be quickly sold in the market without a substantial loss in value. They can be bought and sold with a few clicks on a computer, making them an attractive option for those who may need to access their funds on short notice. Real estate, on the other hand, is illiquid. This means that converting a property into cash is not as straightforward or quick. Selling a property can take months or even years, depending on the market conditions, location, and the type of property. The process involves finding a buyer, negotiating terms, and completing legal paperwork. This illiquidity can be a major drawback, especially if you need access to your capital quickly. The inability to swiftly convert real estate into cash can lead to financial stress and missed opportunities. Imagine facing an unexpected financial emergency and needing to sell your property quickly. In such situations, the slow process of selling real estate can be a significant disadvantage. You may be forced to accept a lower price just to find a buyer. This can result in a substantial financial loss, as you might have to sell the property for less than its market value to expedite the sale. Therefore, while real estate can be a valuable long-term investment, its lack of liquidity is a critical factor to consider. Investors must weigh the benefits of tangible assets against the potential challenges of accessing their capital when needed. Owning real estate isn't just about the purchase price. There are ongoing expenses to consider. Property taxes, insurance, maintenance, and repairs can eat into your returns. These costs are often underestimated by investors. They can quickly turn a seemingly profitable investment into a financial burden. Imagine a leaking roof or a faulty HVAC system. These unexpected repairs can cost thousands of dollars. These costs are in addition to your regular mortgage payments and property taxes. This constant drain on your finances can limit your ability to reinvest and grow your wealth. Buffett's preference for stocks over real estate is also rooted in their potential for higher returns. Historically, the stock market has outperformed real estate over the long term. While real estate can provide steady income, its appreciation potential is often limited. Stocks, on the other hand, offer the opportunity for significant capital appreciation. This difference in return potential is compounded over time. The power of compounding allows your investments to grow exponentially. A small difference in annual returns can translate into a substantial difference in wealth over decades. Section 5. Navigating the murky waters of real estate transparency. Another challenge with real estate is the lack of transparency. This issue can create a lot of confusion and uncertainty for both buyers and sellers. Unlike the stock market, where information about companies is readily available and updated in real time, real estate transactions can be opaque. The stock market benefits from strict regulations and a wealth of publicly accessible data, making it easier for investors to make informed decisions. In contrast, real estate markets often lack this level of transparency. It's often difficult to determine the fair market value of a property because the data is not as readily available or standardized. This can make it challenging to assess whether a property is priced appropriately. This lack of transparency can put buyers at a significant disadvantage. Without clear information, they may struggle to understand the true value of a property or the terms of the deal. Imagine trying to buy a house without knowing its true condition or the prices of comparable properties in the area. This scenario is all too common in the real estate market, where hidden issues and unclear pricing can lead to significant financial risks. This lack of information can lead to costly mistakes. Buyers may end up overpaying for a property, stretching their finances thin, or purchasing a home with hidden problems that require expensive repairs. You may end up overpaying for a property or buying one with hidden problems. These issues can cause not only financial strain, but also emotional stress, as the dream of homeownership turns into a nightmare of unexpected costs and repairs. Therefore, it's crucial to advocate for greater transparency in real estate transactions to protect all parties involved. Section 6. Diversification Dilemma. The challenge of spreading real estate risks. Diversification is a key principle of investing. It involves spreading your money across different asset classes to reduce risk. Diversifying within real estate can be challenging. Investing in multiple properties requires a significant amount of capital. This can limit your ability to diversify into other asset classes such as stocks and bonds. Imagine putting all your investment eggs in one real estate basket. If the real estate market experiences a downturn, your entire portfolio could be at risk. This lack of diversification can increase your overall investment risk. Section 7. Scalability Struggle. Real estate's limits to growth. Scalability refers to the ability to increase the size of your investment without sacrificing returns. Real estate investments are not easily scalable. Each additional property you acquire requires a significant amount of capital and management. This can limit your ability to grow your wealth exponentially. Imagine trying to build a billion-dollar portfolio by buying and selling individual properties. The sheer amount of time and effort required would be enormous. This lack of scalability can hinder your ability to achieve significant wealth. Section 8. The Compounding Conundrum: Stocks versus Real Estate. Compounding is a powerful force in investing. It allows your returns to generate even more returns over time. While real estate can benefit from appreciation, it doesn't offer the same compounding potential as stocks. When you reinvest dividends from stocks, you're essentially buying more shares that generate more dividends. This cycle of reinvestment and growth can lead to exponential wealth creation. Real estate, on the other hand, typically requires a larger initial investment and may not generate consistent income for reinvestment. This can limit the compounding effect over time. Section 9. Emotional Bias. The Peril of Falling in Love with Bricks and Mortar. Real estate investments can be emotionally charged. People often form an emotional attachment to their properties. This can cloud their judgment when making investment decisions. They may be reluctant to sell a property, even if it's financially prudent to do so. Imagine holding onto a property that's losing value because of sentimental reasons. This emotional bias can prevent you from making rational investment decisions. It can also lead to missed opportunities in other, potentially more profitable investments. Section 10. Buffett's verdict: stocks reign supreme. Warren Buffett's preference for stocks over real estate is clear. He believes that stocks offer a more liquid, scalable, and potentially more rewarding investment opportunity. While real estate can play a role in a diversified portfolio, Buffett suggests that it should not be the primary focus for investors seeking to build wealth. Buffett's investment philosophy emphasizes simplicity, patience, and a long-term perspective. He believes that by investing in quality businesses and holding them for the long term, investors can ride out market fluctuations and achieve superior returns. Section 11. The Enduring Appeal of Stock Market Investing. The stock market, despite its inherent volatility, offers a compelling avenue for wealth creation. Over the years, it has consistently proven to be a powerful tool for building wealth, allowing investors to grow their capital significantly. The dynamic nature of the stock market, with its ups and downs, can be intimidating, but it also presents opportunities for those who are well-informed and patient. By investing in a diversified portfolio of stocks, individuals can participate in the growth of the global economy. Diversification helps mitigate risks and can lead to more stable returns over time. It allows investors to spread their investments across various sectors and industries, reducing the impact of poor performance in any single area. This strategy is particularly effective in capturing the overall upward trend of the market. Buffett's success is a testament to the power of patient, long-term investing in the stock market. His approach emphasizes the importance of holding onto investments through market fluctuations, focusing on the intrinsic value of companies rather than short-term market movements. This philosophy has enabled him to achieve remarkable returns and become one of the most respected investors in the world. While real estate can provide a sense of security and tangible ownership, it often falls short of the liquidity, scalability, and return potential offered by the stock market. Real estate investments typically require significant capital and can be less flexible, with longer transaction times and higher costs. In contrast, the stock market allows for easier entry and exit, enabling investors to adjust their portfolios more readily in response to changing market conditions. By understanding Buffett's perspective on real estate, investors can make more informed decisions and potentially enhance their long-term investment outcomes. His insights highlight the importance of thorough research, disciplined investing, and a long-term outlook. By applying these principles, investors can navigate the complexities of the market and work towards achieving their financial goals. The enduring appeal of stock market investing lies in its potential to deliver substantial returns, provided one approaches it with knowledge, patience, and a strategic